Question 11. Explain high operating leverage, high financial leverage. Answer. High operating leverage and high financial leverage indicates the risky investment made by the company's shareholders. This also indicates that company is making few sales but with high margins. This shows the risk if a firm incorrectly forecasts future sales. If the future sales have been manipulative forecasted, then it creates a difference between actual and budgeted cash flow, which affects the company's future operating ability. The financial leverage poses high risk when a company's return on assets doesn't exceed interest on loan, which lowers down company's return on equity and profitability. Question 12. What does financial leverage indicate? What are its limitations? Answer. Financial leverage indicates borrow of funds to raise the capital by issuing shares in the market to meet their business requirements. This also indicates the profitability and return on equity of the company which has taken significant amounts of debt. The financial leverage has many advantages, but it possesses some limitations as well, which has been shown as follows. When a company borrows funds using financial leverage, then this money develops an environment that can either create lots of profits or a small amount of it. Borrowing constantly creates an image that the company might be on high risk, which in turn increases the interest rates, and some restrictions could be handed over to the borrowing organization. Value of stock also gets affected, as it can drop substantially if the stockholders intervene in between. Question 13. What does high/low financial leverage indicate? Answer. High financial leverage indicates the risky investment made by the company's shareholders. Low financial leverage indicates that management has adopted a very good approach towards the debt capital. This decreases the management decision-making on earning per share. Question 14. What is cost of preference shares? Answer. Costs of preference share are also used to calculate the cost of capital and are the fixed cost-bearing securities. In this, the rate of dividend is fixed in advance when they are issued. It is equal to the ratio of annual dividend income per shares to net proceed. It is not used for taxes and it should not be adjusted for the same. Basically, it is larger than the cost of debt. Question 15. What is cost of debt? Answer. It is used to measure the cost of capital. This is the first thing which should be calculated in the beginning to find out the cost of capital. It includes both contractual cost and imputed cost. It is defined as the required rate of return that an investment which is debt has to yield to protect the shareholders' interest. Question 16. What is cost of equity shares? Answer. Cost of equity shares is the hardest job to calculate, and it also raises lots of problem while working on its calculations. Its main motive is to enable the management, which is to make the decisions in the best interest of the equity holders. There is a certain amount of equity capital which must be earned on projects before raising any equity funds or acceptance of finance for other projects. Question 17. What is cost of retained earnings? Answer. Cost of retained earnings have the opportunity cost associated with it, and it can be computed as well without any difficulty. The opportunity cost in this is same as the rate of return of the shareholders, which determine the cutoff point for the deals. It is also the rate of return which shareholders can get by investing after tax dividends in alternative opportunity. Question 18. Explain cost of capital and its importance. Answer. Cost of the capital is the rate of return which is minimum which has to be earned on investments in order to satisfy the investors of various types who are making investments in the company in the form of shares, debentures and loans. It is used in financial investment, which refers to the cost of a company's funds or the shareholders' return on the company's existing deals. It is the required rate that a company must achieve to cover the cost of generating funds in the market. By seeing this, only the investor invests the money in the company if the company is giving the required rate of return. It is a guideline to measure the profitability of different investments. The importance of cost of capital is that it is used to evaluate new project of company and allows the calculations to be easy so that it has minimum return that investor expect for providing investment to the company. Question 19. Explain explicit cost and implicit cost. Answer. Explicit cost is the cost which is external to the business, like wage, rent and materials. It gives clear picture of the cash outflow from business which is used to decrease the end result of profitability. This directly affects the revenue of the company. Implicit cost is the result of one person who tries to satisfy his needs in search of an activity which gives no reward to him by money or another form of payment. It includes benefits and satisfaction. For example, goodwill. It is not counted in terms of money and it is indirect intangible cost. Question 20. Explain average cost and marginal cost. Answer. Average cost is also called as unit cost, which is equal to the total cost divided by number of goods produced, or also equal to the sum of average variable costs and the average fixed costs. This depends on the time period and also has the effect on the supply curve. Marginal cost is the change in total cost which takes place when there is a change in quantity by 1 unit. It depends on the change in volume. It includes at each level of the production additional costs which is required to produce the next unit. For example, building a building requires building the base, then you require extra cost for space and other building material.